While the softness in Q4 FY20 numbers of TCS is on the account of business disruptions in the last fortnight of March, the long-term outlook is suggestive of TCS gaining strength in the post-COVID world with weaker competitors losing the battle. In our Ideas for Profit today, I will discuss what should be investors' strategy on TCS post the Q4 earnings. Now, the quarterly performance was a tad subdued, with several positives nevertheless. Let's focus on the quarterly highlights. The revenue for the quarter at $5.4 billion grew by 3% year-on-year in constant currency. Also, the transition of the workforce to work from home and the delayed approval from some of the BFSI clients to this change impacted the revenue this time around. FY20 revenue grew by 7.1% in constant currency to $22 billion. Now, despite positive currency tailwind, the lower revenue and the cost of transitioning restricted the margin gains that improved sequentially by 10 basis points to 25.1%. Now, in terms of geography, the key market of North America had a muted show, although the continental Europe did better and did well. Now, turning to the industry verticals, communications and life sciences and also healthcare, the relative beneficiaries of COVID-19 definitely did well. The standout positive from the results was the strong deal win that gives revenue visibility in the medium term despite delayed ramp up due to coronavirus or COVID-19 disease. Now, the company added customers across all revenue buckets and has seen a stability in attrition rate at 12.1%. The company also declared a total dividend of 73 rupees per share in FY20, including the 6 rupees in this quarter that works out to a pre-tax dividend yield of 4.3%, providing a downside support to the stock. Now, the disruption in Q4 was more related to the supply side as the company took time to shift the entire workforce to work from home. However, going forward, the revenue impact will actually come from the demand side as economic activities have been severely impacted in key markets of the United States of America and Europe. Now, the management also expects Q1 to be the worst, followed by some impact in Q2 as well. It is still hopeful that the second half of FY21 should be broadly similar to FY20 in terms of absolute level of revenue as per se. Now, management reiterated that the decline during the two worst quarters is likely to be similar to the global financial crisis of 2008. Now, TCS management also expects the revival to be quite sharp. They also reiterated that they would not retrench any of their employees. Promotions would be given depending on the business performance, although they are skipping increments for now. They also would honor the 40,000 campus offers that actually goes on to show the confidence in the medium to long-term business prospects for TCS going forward. Also, moreover, COVID-19 will give a big boost to digital, business continuity solutions and adoption of cloud, etc. And the substantial early investments of the company in these particular areas will only improve its market share going forward. Now, TCS has also strengthened its client relationship and has started gaining business from its competitors. TCS did not allude to pricing pressures and reiterated its long-term margin target within a band of 26 to 28%. Now, there is little doubt that TCS will emerge as a strong long-term survivor post couple of quarters of tumult or uncertainty. However, the valuation is still not cheap, unlike 2008, where at the bottom the company was trading at 9.3 times the trailing earnings. We do not expect such mispricing at this time around because of the liquidity support to the markets from the domestic institutions which were absent right then. Now, investors should use the market corrections to gradually accumulate the stock.